If you're new to Forex trading, there's a good chance the picture you have of it isn't quite right. And honestly, that's not your fault. Most of what gets shared about Forex online is either overly simplified or just flat out misleading. It gets painted as a fast-paced guessing game where you pick a currency, predict its direction, and either win big or lose everything. And that's not really what it is. Once you understand what it actually is, a lot of things start to click that didn't before. So in this video, let's just walk through the basics together. What Forex trading actually is, why this market exists, and how thinking about it the right way can change your whole approach. No complicated jargon, just a clear foundation to build from. Let's go. At its core, Forex trading is simply the buying and selling of currencies. But there's one thing that trips a lot of people up early on. You're never buying just one currency on its own. You're always trading two currencies against each other, and that's why they're called currency pairs. So here's a simple example. Euro-dollar is the euro to the US dollar exchange rate. If that pair is sitting at 1.2000, it means that 1 euro is currently worth $1.20. And that rate shifts constantly throughout the day, but it's not shifting randomly. It's responding to real-world events, interest rates, economic reports, inflation data, political developments. All that affects the currencies are valued relative to each other. So right away, this isn't gambling. Gambling is pure chance. Forex is driven by real economic forces that can be studied and understood over time. It's not a get-rich-quick opportunity, despite what a lot of the marketing around trading might suggest. It's genuinely a skill, and like any skill, it takes real time and effort to develop. And it's not about predicting the future. Nobody can do that. The more useful goal is to learn to read the conditions the market is presenting and make reasonable decisions based on what those conditions suggest. That reframe alone, from prediction to interpretation, makes a big difference in how you approach things. This is something a lot of beginner content skips over, but I think it's actually really helpful to understand. The Forex market wasn't created for traders and speculators. It exists because international trade and commerce requires currency exchange. And think about it this way. When a company in Europe buys products from a supplier in the US, they need to convert euros into dollars to pay for them. When a Japanese investor buys US government bonds, yen have to be exchanged for dollars. And this kind of thing is happening constantly all over the world. And that creates a massive, never-ending flow of currencies being bought and sold. And because this need is constant and global, the Forex market became decentralized. There's no single building or currency exchange where it all happens. Instead, it's a worldwide network of banks, financial institutions, and liquidity providers all connected electronically. When you place a trade through your broker, your order gets routed into that network. The prices you see are coming from that network, not something your broker is generating on their own. And here's the takeaway from all this. The market was built to serve real economic activity. Trading for profit, which most of us are here for, is actually secondary to that original purpose. That's worth keeping in mind because it helps explain why chart patterns alone don't reliably move currencies. The deeper drivers are macroeconomic forces such as interest rates, inflation, and economic growth. Charts can help with timing, but the broader economic picture tends to drive direction over weeks and months. Now here's something that genuinely changed how I approached Forex, and it might be useful for you too. For a long time, I was asking the wrong question when looking at a trade. I kept asking, is this currency going up or down? The more useful question turned out to be, what are the economic conditions telling me about where this currency might be heading over the next few weeks and months? It's a small shift in wording, but it leads to a completely different way of analyzing things. Instead of staring at short-term chart movements, you start paying attention to things like interest rate differentials. When one country's central bank is raising rates while another is cutting, money tends to flow toward the higher yielding currency. And that kind of dynamic can play out over months. You start watching inflation trends because rising inflation forces central banks to respond, and those responses move currencies. You pay attention to economic growth and employment data because strong economies tend to support stronger currencies. And you listen to what central banks are signaling about the future because markets often start moving before policy changes even happen. Now, none of this requires a finance degree. It just takes some time and curiosity to start connecting the dots between what's happening in the world and what's happening on your charts. And when those pieces start coming together, trading starts to feel a lot less like guessing. If you've spent any time around trading communities, you've probably noticed a pretty common pattern. Traders focus intensely on finding the right entry, the perfect setup, the indicator combination that finally unlocks everything, and the results still don't come. Well, here's what is actually going on there. The entry is honestly one of the easier parts of trading. The harder parts are knowing when to stay out, how to manage the trade once you're in it, and how to protect your capital when things don't go your way. A few things tend to trip people up repeatedly. Trading too often is a big one. It feels productive, but more trades mean more costs, more emotional decisions, and more chances for things to go sideways. Slowing down and being more selective tends to help more than finding a new strategy. Misusing leverage is another one. Leverage lets you control a large position with a small amount of capital, and that sounds great until the market moves against you. The ability to use high leverage doesn't mean you should. Keeping leverage conservative is something many experienced traders quietly agree on. Ignoring the spread is easy to do early on, but every trade has a built-in cost, the difference between the buy and the sell price. And if you're trading frequently with tight stop losses, that cost adds up faster than you expect. Relying only on technical analysis is something most traders eventually move past. Charts are genuinely useful, but currencies move because of what's happening in the broader economy. And without that context, chart signals can feel inconsistent. Underestimating risk management is probably the most common one of all. It's easy to treat it as an afterthought, but protecting your capital is really what keeps you in the game long enough to improve. None of this is meant to be discouraging. These are just patterns that show up a lot, and being aware of them early is genuinely helpful. So where does all of this connect to position trading specifically? Position trading is built around the idea that the biggest, most reliable currency moves tend to develop over weeks and months, not hours or days. And rather than trying to catch every small move, the goal is to align with those larger trends as they unfold. That naturally fits how currencies actually move. The macroeconomic forces that drive them don't shift overnight. They build gradually, and position trading gives those forces time to play out. It also means trading less frequently, which keeps transaction costs lower and reduces the emotional pressure of watching every tick in the market. That said, position trading isn't the right fit for every situation, and it's worth being upfront about that. If you need to generate regular income from trading in the short term, this approach probably won't deliver that. Trades can take weeks to develop, and there's no shortcut around that. If wider stop losses make you uncomfortable, it can be a challenge too. Trading on higher time frames means giving positions more room, and that requires a certain level of comfort with how that feels. And if you're hoping to automate your trading entirely, position trading is probably not the best match. It relies on judgment and reading context in ways that are hard to hand off to an algorithm. The bigger picture, though, Forex is a market, not a system. Whatever approach you take, the edge comes from how you understand and interpret that market over time. Position trading is just one framework for doing that well. So, to bring this all together, Forex trading isn't about speed or prediction, and it's not about finding some perfect setup that works every time. At its core, it's about understanding why currencies move and making thoughtful decisions within that movement. For many traders, including myself, the shift toward a longer-term, macro-focused perspective finally made the market start making sense. Not perfectly, but enough to work with. If you want to go deeper on any of this, I put together a full beginner's guide over at positionforex.com. It covers everything from currency pairs and leverage to risk management and macro drivers, all through the lens of position trading. This video was the starting point. The guide is where the full picture comes together. The link is in the description. Thanks so much for watching, and best to your trading.